The housing market didn't just break, it became mathematically impossible. In March 2026, Zillow issued an emergency warning that the mainstream media is completely ignoring. We have officially surpassed the 2006 bubble peaks. Right now, the national home value to income ratio has hit 5.08. To put that in perspective, a healthy market sits at 2.6. We aren't just in a bubble, we are in a mathematical dead zone where the average American can no longer participate in the American dream. Welcome to Nation House Discovery, where we strip away the marketing fluff to show you the real economic signals. If you're tired of the "now is a great time to buy" lies and want the hard data that protects your wallet, hit that subscribe button right now. Smash the like button to help this data reach more people, and comment below with your city. I want to see if you're seeing these price cut signs in your neighborhood yet. You need to see the chart I have for you today, because what it reveals about the smart money exit is going to change everything you thought you knew about this spring selling season.
While the headlines are fixated on high mortgage rates, they are completely missing the silent crisis growing in the background, the shadow glut. While sales volume has cratered to a dismal 9-month low, the actual number of houses sitting on the market is doing the exact opposite. It's piling up at an alarming rate. In March 2026 alone, unsold inventory surged by 3.0%, pushing the national total to a staggering 1.36 million units. This isn't just a slow market. It's a slow-motion supply explosion that is beginning to suffocate greedy sellers who thought they could hold out forever. The hidden truth here is that for every buyer who has gone on strike, a new listing is being added to a stack that simply isn't moving. But the inventory isn't just coming from stubborn homeowners, it's coming from the courthouse steps. We are currently witnessing a 12-month streak of rising foreclosure filings, with early 2026 data showing a 20% year-over-year spike. This foreclosure normalization means the safety net is gone, and the distressed supply is finally leaking back into the system. When you combine these rising foreclosures with the 1.36 million unsold homes already sitting there, you realize the bottleneck is finally starting to break. The math is simple and brutal. As this shadow inventory grows, the competition among sellers will turn into a race to the bottom. This is the leverage you've been waiting for. But before you go out and make an offer, you need to understand that the biggest players in the game, the institutional cash buyers, have already spotted this trend and are making a run for the exits before the floor drops out from under them.
This is where the situation shifts from a housing slowdown to a full-scale institutional retreat. While regular families are still being told that real estate is a safe haven, the professional players, the smart money, are quietly making a run for the exits. In just 1 month, from February to March 2026, cash sales plummeted from 31% down to 27%. Think about that for a second. The very people who have the deepest pockets and the most sophisticated data have suddenly decided that buying houses at these prices is a losing game. These institutional investors aren't just stopping their purchases, they are effectively selling the top and leaving individual, everyday buyers to hold the bag on these overpriced assets. The risk here is massive, because when the big money leaves the room, they take the floor with them. These institutions are looking at the same 5.08 affordability ratio we just discussed, and they realize that the math no longer supports the investment. They are moving their capital into safer, more liquid assets, while the mainstream media continues to encourage you to take on a 30-year debt at the absolute peak of a mathematical bubble. It is a classic villain move, pumping the narrative while they dump the inventory. You are being set up to provide the liquidity for their exit strategy. But here is the real danger that no one is talking about. When these cash buyers exit, it leaves desperate sellers with almost zero options. Without institutional bidders to prop up the prices, those sellers are about to experience a level of desperation we haven't seen in nearly 2 decades. And that desperation is exactly why you need to understand the Rust Belt trap that is currently being set in markets everyone thinks are safe.
Now, while everyone is fixated on the high-profile crashes in places like Austin, where values have already plummeted by 24.6%, There is a far more dangerous narrative brewing in the markets that the mainstream media calls safe havens. We are witnessing the birth of the Rust Belt trap. You've likely heard that the Midwest and Northeast are the places to hide because they are affordable, but the data tells a terrifyingly different story. Look at Rockford, Illinois, where prices have exploded by 32% since the 2022 peak, or Syracuse, New York, which is up a staggering 31%. These aren't signs of a healthy local economy. These are signs of a massive speculative bubble in markets that cannot afford it. The reason these affordable areas are now the most dangerous places to put your money is that they have completely decoupled from local wages. In these Rust Belt cities, home prices are growing at nearly double the rate of local income growth, creating a mini bubble that is far more fragile than the Sun Belt markets that have already begun to correct. When a market like Austin drops, it's a correction of luxury. When a market like Rockford drops, it's a total collapse of the local workforce's ability to own anything. You are being led into these markets under the guise of value, but you are actually walking into a trap where the price-to-income ratio is at its most strained point in history. If you think you are immune to this housing downturn just because you aren't in a flashy coastal city, you are exactly who the smart money is looking for to take over their bad bets. These legacy markets are often the last to pump and the hardest to dump. And once the realization hits that local teachers, nurses, and factory workers can no longer support these 30% price hikes, the floor won't just sag, it will vanish. This is why the consumer strike we're seeing isn't just about high interest rates. It's a fundamental rejection of a system that has moved beyond the reach of the very people who live there. This strike is the only thing that will force the market back to reality, and it's creating a massive real-term decline that most sellers are too blind to see yet.
The mainstream media wants you to feel like a victim of this market, but the reality is that the buyer strike has handed you the most significant negotiation leverage we've seen in decades. With homebuyer demand sitting a staggering 20% below the long-term median, the power has shifted entirely to those who have the patience to wait and the data to strike. This isn't just about being picky. It's about recognizing that the shadow inventory of unsold homes is growing every single day, leaving sellers increasingly desperate as their listings hit the 3-month, 6-month, or even the 12-month mark. When a house sits that long, the seller isn't just losing time, they are losing real-term equity that they don't even realize is vanishing. This is your math-based edge, the hidden decline. Even in markets where list prices appear to be holding flat, the 3% plus inflation we are living through means that every month a seller holds onto an overpriced house, they are effectively losing money in real purchasing power. For the first time in 2 years, real home prices are actually declining across the board, regardless of what the Zestimate says. When you walk into a negotiation, you aren't just asking for a discount. You are highlighting the mathematical reality that their asset is depreciating against the cost of living. You can now use this demand collapse to sneak in and make offers that would have been laughed at a year ago. Because the institutional cash buyers have pulled back from 31% to 27% of the market, you are no longer competing against billion-dollar algorithms. You are competing against other cautious individuals, or in many cases, you aren't competing at all. This is how you secure a $160,000 discount like I did, by finding the sellers who are trapped by their own stubbornness and showing them the exit before the rest of the market realizes the floor has already shifted. To do this effectively, you have to understand the massive bifurcation happening right now, where one neighborhood is crashing while the one right next to it is still living in a fantasy bubble. To truly understand why this market is failing, you have to stop looking at the national average and start looking at the map. Because what we are seeing in 2026 is a violent bifurcation of the American landscape. In one corner, you have the crash zones, the former darlings of the pandemic era, that are now in a full-blown freefall. Austin, Texas is the poster child for this collapse, with home values already slashed by 24.6% since the 2022 peak. But it's not just tech hubs. Florida is seeing a massive unwinding as well. Punta Gorda has seen a 22% drop in value, while the speculative Airbnb gold mine of Sevierville, Tennessee, has watched 12% of its equity vanish as the short-term rental market finally implodes. These double-digit declines are the validation you've been waiting for, proving that the downward momentum isn't just a theory, it is a localized reality that is spreading. But here is the piece of the puzzle that the buy now crowd refuses to mention. While homeownership has become a mathematical nightmare, the rental market is finally providing a profitable escape hatch. Massive multifamily construction projects that started years ago are finally hitting the market, and for the first time in a long time, rents are actually starting to decline. This shift changes the entire opportunity cost of waiting. In the past, you were told that renting is throwing money away, but in 2026, renting has become a strategic move that actually preserves your capital while the housing market corrects. When you can rent a high-end property for less than the cost of a mortgage on a median home,
The mainstream headlines want to keep you focused on the Federal Reserve, telling you to wait for rate cuts, as if they are a magic wand for the housing market. But the most recent data from the Joint Center for Housing Studies at Harvard tells a much more sobering story. Mortgage rates aren't the primary barrier. It's the fact that prices have grown 1.5 times faster than incomes over the last several years. The conclusion is final. Harvard's data suggests you shouldn't be waiting for a dip in interest rates. You should be waiting for a correction in prices. The Rust Belt trap and the mathematical impossibility of the 5.08 ratio prove that we are in a period of extreme risk for anyone buying blindly. You cannot afford to rely on national averages when the market is this bifurcated. You must use specific data tools to track the shadow inventory and the price-to-income gaps in your own zip code to ensure you aren't the one left holding the bag when the local floor vanishes. Time is running out for sellers to realize the smart money has already exited, and the inventory buildup we are seeing today is the clearest signal of what's coming next. In my next video, I'm going to show you exactly which 10 zip codes are officially entering a free fall zone this month, so make sure your notifications are on for Nation House discovery. If this data helped you see through the noise today, please share this video with one person who is thinking about buying a home right now. It might save them from a life-altering financial mistake. Thanks for watching, and I'll see you in the next one.